The cost is the purchase price. And in this question, they've given us, if you have the question printed there, the cost is 3.9 million. Okay, the cost is 3.9 million. So sometimes cost is not only the purchase price. Sometimes there's other costs that you have to add to the cost. Like if the item had transport costs, installation costs, okay. Any legal fees. Now, there's a principle that costs include all things that are required to bring an asset to its present location, condition, and working order. So if you bought a machine and it was at the harbor, you wouldn't be able to use it if you didn't incur transport costs. If it needed installation, you wouldn't be able to use it if you didn't have the installation costs. So you have to add that to the cost. If you buy certain items, you need to incur certain legal costs. Now, without that legal costs, you might not be able to take ownership of it. So all of those stuff will be added to the purchase price. Purchase price is what you paid your supplier for the item. So there's a principle that you must add all costs required to bring an asset to its present location, condition, and working order. But your starting point is always your purchase price. And if there's nothing else, your purchase price will be your cost. So in this question, your purchase price is your cost of 3.9 million. Then the second working that we have to do so that's our cost, and our cost will go in here. $3.9 million. Happy with that. The next amount that we have to calculate, so we've calculated our cost. The next amount that we have to calculate will be our accumulated depreciation. So you see, we've got a working for cost. Now we do a working for accumulated depreciation. Accumulated depreciation. Obviously, in an exam, you'll be writing this out. So how do we calculate accumulated depreciation? Now, accumulated depreciation, if you go back to the note, this is at the beginning of the year. So the beginning of the year is, if you go back to that timeline that we did, is 1 July 20.11. Okay, so that's 9 months. Let me just mute. I think Zonke, can you mute yourself? I can mute you. I can hear a little bit coming through. Let me just, yeah, okay, I can mute you on my side. Okay. So that. Sorry. Okay, so accumulated depreciation. We calculate accumulated depreciation based on the depreciable amount. So the depreciable amount is the cost, which is the 3.9 million. Okay. From the depreciable amount, we always less the residual. The residual, what is the residual given in this question? The residual is initially given at inception as 450,000. Okay. So the residual is always a minus Okay. Obviously, in real life, you'll use a calculator. So you can calculate with me if you want. And that gives you what we call the depreciable amount. Okay, so cost less the residual gives you the depreciable amount. Then we use the depreciable amount to calculate the depreciation to the beginning of the year. Now, how we do that is, if you go back to the facts of the question, we take the depreciable amount, which is the 3, 4, 5, 0, 1, 2, 3. Okay, and then we ask, what is the useful life in the question? And the useful life is given as 360 months. So I'm not using years, I'm using months. Okay. And then we ask, how much depreciation do we want to the beginning of the year? We want actually 9 months. If you go back to that slide, I actually should put it up. But you'll see if we acquired the asset on 1 October 20.10, and from 1 October 20.10 to the beginning of the year, there's 9 months. So we actually want 9 months worth of depreciation to the beginning of the year. So the accumulated depreciation to the beginning of the year is going to be the 3450 divided by the 360 times 9 months. Okay. I'm going to use a formula. You'll obviously use a calculator. I'll just write it out so you can see it as well. Okay, and you get depreciation of 86,250. So that's the accumulated depreciation to the beginning of the year. So it goes into the note 86,250. Okay. Now, what is the carrying amount beginning of the year? The carrying amount beginning of the year, let me get rid of this. The carrying amount beginning of the year is the cost of 3.9 less the accumulated depreciation of 86,250. So carrying amount beginning of the year will be the 3.9, which is the cost, minus the 86,250. Okay, and that's how we get to the carrying amount beginning of the year. So this is the starting point of the note, the carrying amount at the beginning of the year. So the beginning of the year, remember the year is 30 June 20.12. So the beginning of the year was actually 1 July 2011. So now we're at the beginning of the year. Then what else goes into the note? If you have revaluations, then there'll be a revaluation line. But obviously, what did the policy say for buildings? It said for buildings, it's going to be the cost model. So there's going to be no revaluations on building. And I said up front, Unisa is not going to examine revaluations on building because they've said that in their study guide that they won't examine revaluation on buildings. Okay. Then what else?
Savesh,
Yeah.
Intabi is waiting for you to let her in.
Oh, sorry. I didn't even see, she joined late. Okay, I thought she's not coming back. Okay, sorry, apologies, Intabi. Are you back now? Hi, Intabi, are you back?
Yes, you have been waiting forever.
Oh, sorry, I looked and I didn't see you. Okay, sorry. But anyway, I'm recording it anyway, so you'll be able to catch the recording as well. Okay.
No problem.
Okay.
Okay.
Okay, let's pick it up from here. Okay, sorry, I thought you weren't coming back, so I just closed this.
No, I've been here. It's more than 10 minutes now.
Okay, sorry about that. Sorry about that. So we've recorded the start, so you'll be able to watch that as well. So, so we started off with the note. We calculated the carrying amount beginning of the year, and the next part is revaluations, but there's no revaluations on the building. So the next step will be to calculate the depreciation for the current year. So now we've calculated the beginning of the year. So every year there's going to be a current year depreciation charge. Now, once you've calculated the accumulated depreciation, current year depreciation is a very similar calculation. Okay. Current year depreciation is also going to be calculated in a similar way, right? However, you need to be aware whether there's a change in residual or not, right? So how do you calculate the current year depreciation? Now, because there's a change in residual, you have to follow the method that I'm using. You start with the carrying amount at the beginning of the year. So to calculate the current year depreciation, you start with the carrying amount at the beginning of the year. What is the carrying amount at the beginning of the year? It's actually the 3813,750. Can everyone see that? Let me highlight it. It's the 3813,750. Okay, I'm assuming everyone's happy with that. 3813,750. So the carrying amount 3813,750. That's how we calculate. We start calculating the current year depreciation. Then we less the residual. Now, if everyone remembers, the residual in the question was 450,000. If you've got a printed copy of the question in front of you, okay, I'm going to save time. I'm not going to go back to it on my screen. If you've got a printed copy there, the residual was 450,000, but did it remain at 450,000? It didn't remain at 450,000. It changed to 550,000. So when there's a change in residual, you got to use the new residual. So the new residual becomes 550,000. So our depreciable amount becomes, we'll have a new depreciable amount. Okay, see, I'm taking the carrying amount and I'm going to list the new residual, which is 550,000. Okay. And then I need to calculate the depreciation. Previously, notice the difference in how I calculated the accumulated depreciation. I used cost there. I minus the residual, the original residual of 450. I got the depreciable amount. Depreciable amount, useful life was 360, and months to the beginning of the year is 9. Now, when I'm doing my current year depreciation, I'm going to provide for depreciation for 12 months of the current year. So months is going to be 12. Okay, so let me just put this in. So we'll still have the depreciable amount, which will be 3,263,750. Okay. Okay. But here I don't use useful life. I use what we call remaining useful life. I use remaining useful life. And months, I'll explain what remaining useful life is just now. Months, obviously, I said is 12. Okay. Let's go back to the timeline. So it's important to draw a timeline. So when we bought this asset on 1 October 2010, it had a useful life, I said make it into months, 360 months. Everyone sees that 360. Okay. Then 9 months passed. So it had a useful life. That means it was going to have life of 360 months. So as time goes on, that life becomes shorter and shorter. After 9 months, at the beginning of our current year, that remaining useful life can be expressed as 351. 360 originally, 9 months old, 9 months later, it's become 351. And at the end of the year, it will be 339. So remaining useful life is the useful life, but it comes down as time goes on. So at the beginning of the year, the remaining useful life is 351. So that's what we calculate our depreciation on, the 351. Okay. So our current year depreciation will be calculated as follows. It will be the depreciable amount that we calculated, 3,263,750 divided by 351, and we multiply by the 12 months. And we get our current year depreciation of 111,581. So the very important thing to remember is that when you calculate the current year depreciation, you use the carrying amount. If there's a new residual, you use the new residual. You'll get the depreciable amount, and then when you're calculating depreciation, you take the depreciable amount and you divide by the remaining useful life. The remaining useful life, not the original 360, but the remaining useful life. Current year depreciation is always going to be 12 months unless you disposed of the asset during the year, or it was acquired during the year. Then it will be an addition. And if it was acquired, then you'll obviously calculate how many months in the year it was acquired for. So where does this amount go? 111,581. The 111,581 goes into the depreciation line. Okay. That's our current year depreciation that goes in there. Okay. Then how does the note end? It ends with carrying amount, end of the year, cost, accumulated depreciation. Right. Cost obviously does not change, 3.9. Okay. Accumulated depreciation is actually the depreciation at the beginning of the year, 86,250, plus the current year depreciation, which is the 111,581. Okay. So I'll add the 86 to 50 plus the 111,581. That gives me 197, 831. So carrying amount is always cost less accumulated depreciation. So likewise, like we did at the beginning of the year, the carrying amount end of the year will be the 3.9 million minus the accumulated depreciation at the end of the year, which is 197,831. And we'll get a total of 3,702,169. Okay. So that's our carrying amount end of the year. Okay. That's our carrying amount end of the year. So that's basically the critical things is to calculate the carrying amount at the beginning of the year, and the timeline is important for that. Then there's depreciation every year. Okay. So depreciation, don't forget to put it in brackets because it's a minus. And likewise, accumulated depreciation will also be in brackets. Okay. So that's how the note will look at. Obviously, Unisa said they're not going to examine revaluations of buildings, so there'll never be anything in that line. Okay. The next step is, while we are working with buildings, is to complete everything relating to buildings. So we've actually done with the PPE note. For buildings. But you will notice in the required, if you go back to the required, that buildings, we also need to calculate the deferred tax. Now, how do we calculate deferred tax? Deferred tax is always calculated by taking the carrying amount, okay, comparing the carrying amount to what we call tax base. That gives us the difference between those two, gives us the temporary difference. And then we compute our deferred tax. So we are doing this calculation for the building. Okay. Now this does not fall into the PPE note. This falls into the deferred tax note. Why I suggest from an exam technique point of view, you do it now in your workings, and you can see how your workings are looking so far: 1.1, 1.2, 1.3, 1.4. Why I suggest you do it now is because the numbers relating to the building are fresh, but you'll have to create your other note below this, which will be the deferred tax note. Okay, you'll call it deferred tax, and we'll write the narration. Okay, but first, to do the deferred tax note, we have to calculate the answer. Where do we get carrying amount from? Carrying amount is the amount that we calculated for accounting that's in our note. The amount that we calculated for accounting that's in our note, carrying amount end of the year, is the 3702 169. 3702 169. Everyone sees that, right? Tax base. So carrying amount is straight from your note that you did. Where do you get tax base from? Tax base, we have to calculate. Okay. It's calculated in terms of tax rules. Okay, it's calculated in terms of tax rules. Okay, and in every question, they're going to give you how tax is calculated. So you need to refer to the taxation part of your question, and you'll see they give you some information here. The tax rate is 28%. Capital gains tax is 80%. But here's the important thing. They allow capital allowances. An allowance of 5%, okay, for 5% is important on all manufacturing buildings. So you know our building is a manufacturing building. In terms of section 13(1) of the income tax on a straight line method, not a portion for part of the year. An annual building allowance, so 5% is critical, not a portion is critical, and part of the year. Okay. So how do we do this calculation, right? So the critical thing from that, you can go back to it on your own if you have it printed. How do we do it, right? Cost is 3.9 million. Cost for accounting and tax is always the same. Okay. Then we need to calculate our tax allowances. Sorry. Need to go to, okay. So if you go to that timeline, you'll see that we acquired this in the prior year. In the prior year, we had it for 9 months. But it's not apportioned for tax because the tax rule is not apportioned. So we're going to get our full 5% for the prior year. So we're going to get tax allowances for the prior year, which was which was equal to 3.9 million. Times 5%. And remember, we don't go 9 over 12 because it's not apportioned. Okay, 195,000. Okay, so this was the year ended 20.11. But then we're also going to get tax allowances for the current year. That'll be for the year ended 20.12. And we'll get another 5%. So that's going to be 3.9 sorry, make it a formula, 195,000. This gives us what we call our tax base. Our tax base, and we'll pause as soon as I've done this part. Our tax base is the 3.9 million minus our tax allowances, which is 195,000 for the prior year, and minus 195,000 for the current year. Okay, and my tax base becomes, so it's 3.9 minus that gives me 3510.123. What's my temporary difference? My temporary difference is carrying amount minus tax base. Carrying amount minus tax base. It's equal to 3702,169 minus 3510. Okay. Okay. And we get our temporary difference of 192,169. Right. So that's how we calculate the deferred tax on the building. Okay. So we're going to take our next break now for 10 minutes. And then we're going to start again thereafter. So just quickly, is everyone happy at this stage so far? If you can unmute yourself, and then we're going to stop and start again in 10 minutes. Any questions?
Savesh,
Yes, yes.
are you going to send us this notes?
Yeah, I'll send you everything. I'll send you everything. Even the recording of the class. So you'll get everything. So I'll click record. So everything's being recorded.
Okay.
Yeah.
Okay.
Okay. This is in Tabi or Zonke?
No, it's in heavy.
Oh, okay. So sorry, you missed the start. So it'll be recorded.
Okay.
Okay. Okay. Let's take a break and we'll come back after the break. Okay. Okay. See you guys just now.